All right, folks, good morning. This is Dan Passarelli, and we have got a really interesting presentation here today. And before we get started, I need to make sure you can hear me. So please make your way on into the questions box and let me know that you can hear me, please. All right. NTIS, a regular around this joint. Great. Uh, Everybody else can hear me? Yes. 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 All right. Lucas. Yeah, man. All right. That's what I like to see. I love it. Okay. Well, today, what we're going to talk about is put call parity, volatility, and skew. Now, this is what you would generally consider to be an advanced options presentation. And I don't know, to me, this is something that it's kind of an interesting group of topics here. Because on the one hand, things like put call parity, you might not ever intentionally trade directly, but you'll always trade them indirectly. And the more you understand it, the better of a trader you'll be overall. So let's jump into it. Before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And what we're doing here today is giving general information. This is not personal advice. All right. For those of you who are not familiar with me, I see a lot of familiar names in here, but here I am. Oh, I'm wearing the same shirt as in the picture. What do you know? My name is Dan Passarelli, and I'm an author of two popular options trading books, Trading Option Greeks and The Market Taker's Edge. I'm a trader. I started down on the trading floor in Chicago in 1993 and been trading ever since. Now I trade in a retail brokerage account just like you. And I'm the president and founder of Market Taker Mentoring, which is the global leader in option trader education. And I work with a lot of companies in the options industry. I've worked with every major exchange, literally in the world, in some capacity or another. I have worked with all the options friendly brokerage firms in the US in some capacity or another. All the good companies, good platforms like Firstrade, for example. And I'm a family man, married to my wife, Kathleen, who many of you know, and my two adult children. And I do other things to have fun. I'm a runner, a foodie, traveler, a musician, been all over the world, and eat my way through cities all over the world, and enjoy playing and listening to music. Now, I want to give you something to leave here with after we're done. If you go to markettaker.com, and you can do that now if you'd like, market as in stock market, taker as in take what is rightfully yours, two T's in a row, markettaker.com. And just click on join free. There's a lot of complimentary classes there, and I would love to share them with you. You can join our community for free. So let's jump into this now here. So what is an option worth? Right? Seems like kind of a weird question, probably, right? Like, what does that even mean? What is an option worth? Well, when you buy any other asset or sell any other asset for that matter, you think about what the value of it is. Do you do that with options? Right? If you go to buy a car at a car dealer and it's a brand new, whatever, BMW, and the car salesman says, oh yeah, well, this brand new BMW, we're offering it for $10,000. You're like, wait a second. I know you don't say it out loud. The first thing you say is, yes, where do I sign? But in your brain, you say, wait a second, 10,000, this car is worth a lot more than $10,000. Uh, yeah, I'm going to buy it because I know the price is less than the value. Or if he says, well, it's $250,000, you say, what the heck is this guy talking about? And that you actually say out loud to him. What the heck is this guy talking about? This is a nice car, but it's not worth $250,000. I would never pay a price higher than the value of this car. But with options, there's a lot of moving parts. There, you just see the screen with a bunch of prices and you think, well, okay, this is what the trade is, and I hope the trade works out. But I want to challenge you to think about it a little bit differently today and think about valuation. And there are two very useful tools to value options: put call parity and option pricing models, that you should be very intimately familiar with if you're trading options. Let's start with put call parity. So this is actually a long existing tool in various forms. It's actually predated listed options, because you might not be aware of this, but options started trading on an exchange for the first time in 1973. That was at the Chicago Board Options Exchange. And that was the first time an exchange ever traded calls and puts. However, options were traded for centuries and centuries before then. One could argue millennia. For example, the Dutch tulip craze of the 1400s. I think it was the 1400s, 1500s. Maybe it was the 1500s. Options traded not on an exchange, but just among individuals. So put call parity always existed to some degree, but now it becomes a lot more useful, a lot more functional, and can help you in your trading of listed options. What put call parity does is it mathematically equates functionally comparable positions containing options. So what does that mean? I'm not the kind of guy who likes to use long words for the sake of using long words. And I know functionally and comparable are not super long words, but I want to clear up any, misunderstanding of that definition. So, if I buy the December 100 calls or the December 101 calls, it's not a real big difference in how much I'm going to make or lose on those two trades, right? They function in a pretty comparable way. Whereas if I buy the December 100 calls and the August 50 puts, like those positions are not related very much at all. So options that do function in a comparable way, specifically options in the same expiration that have the same strike, which I will refer to as the put call pair, because they're the pair of a call and a put in the same expiration, same strike. We can equate them in a number of different ways using put call parity and transforming them into what we call synthetics. Now, this is all predicated on arbitrage relationships. All right. So put call parity is this very mathematically intimidating for a lot of people equation that I'm showing right here. C plus the present value of X equals P plus X, S. Okay, so C is just the call price. The present value, PV of X, it's a present value of the strike price. And if you never took a finance class in college, you might not have heard that phrase before, but we're going to clear it all up in a minute. P is the put price and S is the stock price. So you look at that, that's a little clunky. With this explanation, most of this probably makes a little bit more sense. But this is what I like to call the math nerd version of this equation. Let's turn this into the trader-friendly put-call parity equation. So the call plus the strike minus the interest. That's what present value means. Because, you know, if you think about it, and I'll just break this down here for a second. If you think about it, if I buy the 100 strike calls at say $2, and there's a month until expiration, I know I can exercise that call and buy the stock at 100, but I'm controlling $100 worth of stock with only $2 of the call premium. So basically what I could do is I could take that $98 that I'm not spending and put it in the bank and earn interest on it. So the present value of that $100 investment is actually a little less because by the time it's all said and done, a month later when I exercise the call, I have that interest money. So it kind of cost me a little bit less. So that's what present value means. So the call plus the strike minus interest equals the put plus the stock. Okay. Now, if you think about that, like without really even doing anything here, we can kind of make some sense out of this in just, you know, a talking it through type conversation here. So first of all, if I buy a call, I have limited loss, right? Because I can only lose the $2 I pay for the call. But if the stock goes up, I can exercise the call and basically I own shares, so I can profit as high as the stock wants to go. But, you know, there's that extra $2 cost minus interest. So it's not quite like owning the stock above the strike price, like owning the stock above the strike price minus the call, you know, minus interest. Well, if I own the stock and I buy a put, conceptually, I have a pretty similar scenario there, right? If the stock goes down, I can only lose so much because I can exercise the put and sell the stock. If the stock goes up, then just whatever I paid for the put, I lose, but the stock can continue going up. So, like, it can't really be a situation where the 100 strike call is trading for $2 and interest is, you know, just a little bit of money, and the put's trading for $10, right? Like, that wouldn't make sense. Because then what I would do is I would just buy the call and I would sell the put and I would sell the stock short. Because basically the call, considering the strike and taking into account interest, equals owning a put and owning stock. So the prices have to be mathematically aligned. Otherwise, there's an arbitrage opportunity. So we can do a little bit of algebra. Algebra, remember that? You didn't think you'd have to be doing algebra as an adult. You thought that was something that, teachers tortured children with, right? Well, turns out algebra comes in a little bit handy, and it's not really that intimidating. You can probably remember this kind of stuff. All we do is we're subtracting. Okay, so call is the same here. Strike is the same here. Stock is the same here. Interest is the same here. All we're doing is subtracting put from both sides of the equal sign. So this is a long put. We're going to sell a put. So put a negative put in there, and that zeroes it out. So now it's only stock on this side of the equal sign. And then we're going to put minus put, which is short put, on this side. So basically, long call, given the strike, and a short put, taking into account interest, equals long stock. Now we're getting somewhere interesting. Now we could also take into account dividends, right? Because if I own a call at a particular strike and I'm short a put at a particular strike, I take into account interest on all this. In fact, before we do that, let's back up and talk about this and take into account interest. Let's say we're talking about the 100 strike call and put, right? Remember, put call pair that both expire in a month. And we can buy the call for, say, 2 and sell the put for, say, $190. Yeah, just $190. Okay, so we're paying 10 cents to own the call and short the put, right? Pay 2, collect $190, that's 10 cents. Well, if it's the 100 strike, what happens if the stock is above 100 at expiration? Well, you exercise the call and the put expires. Okay, so how much do you pay for the stock? Well, you exercise the call to buy it at 100, but you paid 10 cents for the call minus the put. So you're actually paying $100.10. Well, if I would have just bought the stock that day instead, I would have paid 100, but I would have tied up all that capital that instead is sitting in a money market account earning interest. So I'm willing to pay a little more because it saves me interest. I put that money in the bank. If the stock's below 100, then I get assigned on the put and the call expires. I'm still buying the stock at 100 plus the 10 cents that I paid for the thing. Does all that make sense so far? Give me a yes if that makes sense so far. Yes, hit that questions box. Give me a big old yes if all that makes sense so far. All right, Peter's on track. Good. Aslam is on track. Good. And if it doesn't, you can tell me. I'm here to help you. All right. So now let's take into account dividends. Ahmed says yes. Good. So we get how interest factors in there. But what about dividends? Well, if I own stock, I collect a dividend. But if I own a call, I don't. If I'm short a put, I don't. So just like interest is an advantage to owning the call and shorting the put, so you have to add it in to make up for the fact that the money's sitting in the bank and we're getting interest. If we account for the dividend, well, we kind of have to do the opposite, because if I own the stock, I get the dividend. So this stock is worth stock price plus dividend at some future date. But if I am long the call and short the put, I don't get the dividend. So in order to make this equal, the stock price and the dividend, I've got to add it into the long call short put side. Now, all this stuff about adding in the interest and dividends and accounting for the strike and all that, that's all fine and good. But here's the thing. Let's just make this simple. We know that they're the same strike, okay? Like, let's take this from algebra to just trader think, okay? We know they're the same strike. We know interest plays a role. We know dividend plays a role. All I really need to know as a trader is if I'm long a call and short a put, that is the same as being long stock. This is a simplified version of the equation. Just, it's less mathematical, but it's more trader think, or at least how my trader brain thinks. So this brings us into the world of synthetics. Synthetics are functionally comparable positions containing a combination of options and stock. And they can be created to relate any basic or even complex options position. So this is what we were just looking at right here. This is called synthetic stock. I buy a call and I short a put. I have a position. Once I account for interest and dividends, I have a position that acts exactly like long stock. And, you're probably used to seeing these profit and loss diagrams, P&L diagrams. Well, the P&L diagrams will look exactly the same. Okay. And the amount of money I would make, because I'm mathematically actually taking into account the effect of interest and dividends, will be exactly the same. And so that works if I just algebraically multiply both sides times -1, which basically means the stuff I was long, I short, and the stuff I was short, I long. So sell a call and buy a put equals short stock. And this is, shorting stock. Every inch it goes below, every tick it goes below 100, I make a tick. Every tick it goes above 100, I make a tick. Well, it's the same thing if I short a call and long a put. So now let's change that up a little bit more. What did I do here? So on the top line here, I'm adding put to both sides, right? Plus put here, which zeroes this one out, plus put here, which is long call equals long stock plus a put. And this is what I was talking about before, in that if I buy a call, I can only lose what I pay for the call, but I can have unlimited profit potential. And it's the same thing with long stock and a long put, which is called a married put or a protective put, depending on the timing of when I buy that put relative to when I buy the stock. If I short a call, it's the same as shorting stock and a shorting a put, right? What about this? Do a little more algebra here. If I'm long a put, that's the same as being long a call and short the stock. Let's gloss over that one a little bit and go to one that might be a little bit more near and dear to some of our hearts. being short a put equals being short a call and long stock. Okay, well, does anyone know the name of the position short call long stock? You're long 100 shares of a stock and you're short one call. What is that called? What is that called? Anybody? Somebody knows. Let's see how good you guys are. Ah, Lucas, great job. Peter, great job. A covered call, right? Well, hold on a second here now. This is pretty crazy. So you're telling me a covered call is the same as a short put? And yes, considering if we have enough cash to buy the stock if we get assigned, yeah, it is. But we don't really think about covered calls and cash secured puts as being the same thing, or at least some people don't. And that's fair. I'm going to sit here and I'm going to tell you that they actually are the same if they're the same strike price. Now, functionally, practically, when we trade covered calls, we typically own the stock and sell a higher strike call that's above the stock price, that's out of the money. When we sell a cash secured put, we typically sell a put that is below the stock price, so it's out of the money. So sell the higher strike call, sell the lower strike put is how we typically do it. So we typically are not using the same strike, which is why we when we trade these, we handle them different from each other. But if we were to sell an in the money put at the same strike, we would consider buying the stock and selling a call. Well, that ends up being exactly the same deal. We're going to make or lose the exact same amount of money. Now, I've talked to even a pretty experienced person recently who said, wait a minute, that's not true because, I don't lose money on the short put if it goes down, but I do lose money on the long stock. But the fact is, you do lose money on the short put if it goes down. You just don't lock in the loss for tax purposes. The money's not there anymore, right? If you decide to sell it at that point, you're not going to get as much. The value of that position is less than it was if the stock goes down. So it's really more just the timing of when you buy the stock. Either way, if the stock is below the strike price, it was below the strike price with the short put, you get assigned and now you buy stock. If it's below the strike price with the covered call expires and you own the stock. Either way, you're going to own the stock in the future. If the stock is above the strike price with the short put expires, you got no position. If the stock's above the strike price with the covered call gets assigned, stock gets sold, you got no position. There, of course, is that interest rate component, maybe a dividend component. That accounts for slight differences, which really affects the theta of it. But, that's it. They're functionally the same positions. And the more you warm up to that idea, the better of a trader of covered calls and cash secured puts you're going to be. Because I've had people tell me, wait a minute, Dan, no, that can't be true. I'm not going to believe it. Well, if you try and wrap your head around it, you're going to trade better. Okay, so why do we care about these things? Well, for lots of reasons, because you can trade better. You can make better trading decisions with synthetic stock, long or short. We can get much greater leverage. If you buy a stock on margin, how much do you have to pay? Well, you can buying stock on margin means you're borrowing up to 50% of the value of the stock. But it depends on your broker and the clearing firm. It depends on a lot of things. So what I'm going to say here is true in a lot of cases, but you should definitely talk to the good people at Firstrade about exactly what the margin requirements are. But the margin requirements for synthetic stock is a lot more lenient than 50%. It could be up to only having to put up 20% of the value of the strike price. 5 times leverage instead of 2 times leverage. Instead, you have to just post some margin. Instead of borrowing money and buying the stock, you're just posting margin. This can sometimes be used on interest plays. Hey, if I think, we've been following the Fed for a while, trying to anticipate what they're going to do with interest rates. Let's say you believe very strongly that for whatever reason, interest rates may go back up or might go down faster than people expect. Doesn't matter. Well, if you know that this equation right here, call plus strike, call plus strike, long call and short put, taking into account interest equals the stock, you can basically bet on the interest rate because this relationship of the synthetic stock to the stock is contingent on the interest rate. If you anticipate the interest rate changing in such a way that others don't, you can literally trade the interest rate changing. Pretty crazy, right? Synthetic calls or synthetic puts. If I buy stock, like give me a yes if you have ever owned stock and bought a put for protection. Give me a yes if you've ever owned stock and bought a put for protection. Ahmed says yes. NTIS says yes. Aslam says yes. Okay. Well, I mean, if you buy those at the same time, you probably could have done better by instead of buying the stock and buying a put, you could have just bought the call. And because first of all, there's 2 commissions on buying the stock and buying the put. Whereas buying the call gives you the same risk reward, same win or loss, and the margin requirement. As far as the OCC goes, the margin requirement on this is with Reg T margining, which most people have. The margin requirement on owning stock and then owning a put is you have to put up 50% of the value of the stock and 100% of the value of the put. So let's say the stock's 100, you have to put up $50 plus the value of the put, so $1.90 in this case. So that you have to put up $51.90 to carry that position. Or you can do the one that works exactly the same and just buy a call for $2. So $5,190 of money or $200 of money. One cost you less in margin, less capital tied up. You can theoretically put it in the bank and earn commissions on it or earn interest on it. You're only paying 1 commission. And you can possibly get a better price because there's 2 bid-ask spreads with the stock and with the put. And if the put's in the money, like usually in the money options have wider bid-ask spreads, you could probably do way better in every way just buying the call. And let's face it, it's easier to do your risk valuation. Something with one moving part is easier to wrap your head around than something with two moving parts. All right, so this is all fine and good, but truth be told, there are some limitations. First of all, put call parity is only valid for European exercise options. Well, hold on a second. Dan, equity options on individual stocks, they're all American style. So what? None of this conversation matters? No, that's not what I'm saying. Early exercise and other factors, they change the math for put call parity, but not drastically. You still basically have the same position, but if you just think in your brain about the fact that, oh, well, I might exercise this early for this reason, or I might get assigned on this early for that reason, you're off to the races and you can still use this to make great decisions. Complex options models can adapt for American exercise options. So instead of just using straight put call parity, we'll use what is called an options pricing model. Generally speaking, the small mathematical differences on put call parity don't matter much to a typical, non-professional or retail trader like you and me. Synthetics are very practical still with American exercise options. So some practical uses are, arbitrage. Finding some very small price discrepancies between calls and corresponding puts can lead me to locking in a profit. Doing things like conversions and reversals, which is basically just like buying the synthetic stock, shorting the stock. That's all you're really trading is the interest rate there. When I was on the trading floor, trading as a market maker down in the pit with a funny colored jacket, yelling and screaming all day, I traded conversions and reverses all day. I just did the math in my head all day long. For non-professionals, take advantage of your knowledge of synthetics. Hey, instead of going and buying the stock and buying a put, I'm just going to buy a call using the same strike. Instead of buying a stock and shorting a covered call, maybe I'll just sell an in the money cash secured put, one commission. I'll get assigned later and I'll buy the stock that I want. Right. And it works. It really does work for more complex positions as well. Debit spreads are synthetic credit spreads, but I don't want to get too heavy into that because I want to have time to move on to the next topic, which is option pricing models and volatility. This is an alternative or really an additional way to value options. The Black-Scholes options pricing model was first invented in 1973. Incidentally, the same year that options got listed for the first time on exchanges on the CBOE. It's valid for non-dividend paying European exercise calls, specifically. But it can be adapted to puts and such. Other models for American exercise options, there's the Cox-Ross-Rubinstein and others, binomial. Can you scan for the put call parity? Oh, you mean like put call parity discrepancies? I don't know of any existing scans out there. But if you have some programming skills, you probably could. For sure you could. Professional traders call those electronic eyes, and they create those for arbitrage opportunities all the time. Now, the inputs for valuing American exercise style options using a convention pricing model, There are six: stock price, strike price, time to expiration, interest rate, expected dividend stream, and volatility. Now, all of these, well, most of these are readily observable. Stock price, we just open up our Firstrade account and look at the price of the stock. Strike price is whatever option we're talking about. Time to expiration, just look at the calendar app on your iPhone or Android or whatever. Interest rate, interest rates change fairly slowly, typically. And have changed, a quarter basis point every 3 months here for the last 3 months. We went like a decade without them changing at all. I mean, we basically know what the interest rate is. Expected dividend stream. Companies typically keep their dividend policy the same. In a perfect world, some companies try and raise it a little bit every year. If the company's doing particularly poorly and the stock price is down, then they might cut it. I mean, you basically know what the dividend stream is. The only one we don't really know is volatility. So that's the one we have to talk about. There's two general categories of volatility: historical or realized volatility and implied volatility. And both are stated in the terms of the same units, which is annualized standard deviation, which is useful because it makes it easy to compare the two. So here's the gist. Historical volatility is a measure of how much price movement a stock has endured in recent past. And typically we look over the last 30 days. Some applications allow you to change that to 10, 20, 60, 90 days, whatever, but that's really not that common and really not that necessary, if you ask me. The typical historical volatility calculation is the annualized standard deviation of the closing prices of a stock from the last 30 days. Now, the last 30 calendar days is really about 21, 22 trading days. So HV doesn't necessarily have anything to do with options. We're literally just taking the closing prices from the last month, finding the standard deviation, which is a fairly straightforward calculation. You can look it up. And then we annualize that month to make that 1 month representative of a 1 year period. I didn't even mention the word options in that definition because even stocks that don't trade options, you can calculate the historical volatility on them. But implied volatility is a different animal. Implied volatility is a relative measure of how cheap or expensive options are. It measures the cheapness or expensive independent of other variables in the pricing model. So if we hold stock price constant, time to expiration constant, assume interest and dividends don't change. If a big trading firm comes in and buys 5,000 of these calls, well, supply and demand, the law of supply and demand says the price is going to go up. That is implied volatility. Now, if the price goes up or down because of demand or supply, respectively, we presume that to be somewhat based on the trader's expectation for future volatility, which kind of makes a little bit of sense and is a little bit true. If you think the stock's going to go up just a little bit, you'd probably just buy the stock and not waste money paying for this option that's going to decay in value. But if you think the stock's going to go up a lot, there's going to be a lot of volatility, but you're afraid it could go down a lot, you're way better buying a call because you get more leverage and it's okay to spend some money on the call because you're going to make so much more based on the amount of money you put in. And if it goes down, you can only lose what you put in. Whereas if you bought the stock, you stand to lose a whole bunch more. So more accurately, Implied volatility is a measure of the effect of buying and selling pressure for options. Different options on the same underlying can have different volatility values as well, and that is a topic called skew. Skew is the observation that different options on the same underlying stock can have different volatility values. So there's this relationship here, okay? And this is, I'm going to go with that functional word again, right? Because options on the same underlying can have similar functional utility, volatilities are generally related. So again, I could buy the 1 month 100 strike call or the 1 month 101 strike call, and it kind of doesn't really matter that much. So their volatilities, the supply and demand for them is about the same. But if I'm buying the December 100 calls and the August 50 puts, well, those are doing two different things. They could have different supply and demand for them, and they will. So the further you get away from, the further apart the strikes are, the more variant the volatilities can be. And the further away in expiration, the more variant the volatilities can be. But when they're close, either vertically in price or horizontally in time, we tend to get a smooth, methodical sort of skew. And this is something you should know. You might not be able to necessarily observe it on all the platforms that you might use or anything like that, but the concepts are very important. Vertical skew is the observation of varied volatility values among the different strike prices within the same expiration or on the same underlying. And term structure of volatility, which is just a fancier way of saying horizontal skew or time skew, is the observation of varied volatility values among different expirations of options sharing the same strike on the same underlying. So typical equity option vertical skew is we get successively lower strike prices. So if we go from the 100 strike to the 95 strike to the 90 strike, which I would typically just say the puts, because remember, put call parity says a call and a put of the same strike are synthetically equivalent. So I just think in terms of the out of the monies, I just call those lower strikes puts. They tend to have higher implied volatility than the higher strikes. And that's true for a lot of stocks and indexes, but not all of them. And that relationship is mainly for stocks and indexes. If we're talking about oil or corn or soybeans or gold, that could be very different. Now, the shape of that skew, if we were to kind of graph it, and now we're starting to get into a little bit math nerd sort of stuff, but this is good information to know. It can be steeper for those lower strikes than the higher strikes. And if you think about it, that's because bigger moves tend to happen to the downside, and that's where the fear is. People are more likely to buy puts, especially if the market's going lower, especially the lower strike ones that are cheaper. People tend to really create demand for those lower strike puts. Higher strike calls, what do we do with calls? Well, we sell covered calls and such, right? But the higher the strike, we don't see calls get a lot cheaper with higher strikes like we do with puts with lower strikes. This can be thought of linear or curved, and it's accurate only in options with sufficient time premium. Once you get out, like I was looking at some stocks options today. And, they're like 0 bid at a dime. Well, I mean, that's just like so wide of a market from a Vegas standpoint that the implied volatility is just going to be really thrown off. So once you get so in or out of the money, you just kind of stop looking at the volatility. Now, the term structure of volatility, right? Options with less time until expiration tend to have more dynamic changes in IV than options with longer term expirations. I think of it as kind of like a whip, right? You're holding a whip and you're holding this part. This is like the leaps, options with a lot of time until expiration. You just give a little tiny flick to your wrist. The whip just moves a little bit at the point where you're holding it in your hand. But the other end of it is expiration. And that part whoosh, whips a lot. That's kind of what it's like when implied volatility changes over the different expirations. Successive expirations tend to either rise increasingly or fall increasingly. So the front expiration, the shortest term options tend to gain value or lose value first and most. But then if the front expiration gains value, well, the next expiration probably gains a little bit, and the next gains a little bit, and the next gains a tiny bit, and the next might gain a smidge, and like that. One reason for a deviation of successive rising and falling is the existence of a planned volatility event. Sometimes you'll look at, this week's expiration volatility is 20. Next week, it's 19 and a half. The week after, it's 19 and a quarter. The week after that, it's 19. The week after that, it's 32. Whoa, what? 32? Why is it like that? Well, it's because that's the week that has earnings in it. All the other ones expire before earnings. And that has lots of important implications. All right, now there's some practical uses of volatility and skew. Let's talk about those. Volatility, like the other variable inputs in the options pricing model, is one individual component that leads to profit or loss on an option trade. Just as option traders consider the risk reward of the stock rising or falling or time passing, they need to consider the risk reward of volatility itself, right? So many traders spend a lot of time planning their call and put trades saying, oh, look at this chart. Looks like the stock could continue going up. Okay. Or down. A lot of traders look at theta. They look at time passing and say, man, I'm going to put on a credit spread and I'm going to make money as time passes on theta, time decay. Great. You should do both of those things. But we also need to consider, hey, what if volatility changes? And how is volatility likely to change? These options are going to get cheaper or more expensive based on volatility changing. And if you want to be a great option trader, you need to forecast that as well. The thing about volatility and value is, well, they make options cheaper or expensive. So we always want to buy low and sell high, right? Well, implied volatility can be thought of as the price of an option holding direction and time and interest constant. So we got to forecast and value implied volatility and attempt to trade for favorable value. So, we want to use things like volatility charts if we have access to that. And you can Google how to get access to that. So if I'm ever buying options, I'm buying volatility. Those of you who watched my series on the Greeks, right? If I buy an option, I get positive vega. I also get positive gamma. Both of those are buying volatility. So if I'm buying options, I always want implied volatility to be cheap, like in the bottom half of the past 6-month range, below historical volatility. And I should probably be expecting a rise in volatility. But if I'm ever going to consider an option selling position, then I know I'm selling volatility. I want IV to be expensive, like in the top half of the past 6-month range, above historical volatility. And I should expect it to fall going forward in the future. And this is just sort of a picture of, what some of these things that we've been talking about might look like. This is your vertical skew going through the strike prices. Maybe the at the money is somewhere around here, 268 or something. Well, the lower strike, we see the implied volatility go up, right? The higher strikes, we see implied volatility go down. But when it goes up, for the put side, the downside, here it goes up by 0.6, by 0.8, about the same here roughly. But when it goes up, or when we're talking about the higher strikes and it goes down, it's just going down by 0.3, by 0.1. That's what I was talking about. In your horizontal skew, this is pretty common. You want to get really fancy, this is called the contango market, where the further out in time we go, the higher the price gets, right? We don't see like 20.8, 22.7, 14, 35, 62, like it's not all over the place. It's kind of a smooth line. So put call parity, synthetics, volatility, skew, all these things we talked about, these are important tools for option traders. The more you understand these things, the better of a trader you will be. These are the things that we teach at Market Taker Mentoring that I just had a student say yesterday in a class, man, nobody else teaches this stuff, and this is so valuable. And it's because it is so valuable. It can potentially help you reduce risk, make better risk decisions, reduce commissions and margin capital, making your trades cheaper, and add value to a trade because you're just trading them smarter. All right. That is everything I have for you today. Do we have any final questions before we part ways? Have any final questions before we part ways? No? All right, folks. Well, that is everything that I have. I hope you got a lot out of that. And have a great rest of your day. I will see you next week. See you, Ahmad. See you next week when we talk about, we've got good stuff to talk about next week. Pro level options. We're going to talk about secrets from the trading floor. That's going to be a good one. All right. See you then. Bye.